If you haven't been invested in the AI infrastructure stack over the last couple of months, then it has been a rough time for you as an investor. But how long can this last? And which stocks are the ones that are most likely to be safe? And which ones are the most likely to crash? Well, my name is Brian Stoffel, and today what we're going to be doing is going through a ranking I did, 25 AI stocks, and we're going to talk about them from safest to most likely to crash, except we're going to do that in reverse order. Now, which stocks are we talking about? We're going to go through all of these hype names in the AI infrastructure stack, and they kind of hit on all the different levels. Now, when I do this, I think the most important thing to know is I'm trying to answer one question. Which of these will still be thriving in 10 years? So we're not talking about will this supply and demand thing be met in the next 2 to 3 years. I'm talking about if you're a true buy and hold investor. If that's not you, then take that into consideration as we go along. And as we do this, I'm going to be evaluating all three companies based on three very simple concepts, and I'm going to go through them quickly for the sake of time. One is a company's moat. Two is the company's optionality or ability to create new revenue streams in the future. And number three is the company's valuation. So as we go through, you will see a green for this is strong, yellow for it's mixed, and a red for this is fragile. And we're going to have four different buckets. The first one we'll go through is the riskiest stocks. These are the ones that I think are downward skewed over the next 10 years. The second bucket, it's really important to point out, is the one that has the widest variance. The stocks in this bucket are very highly likely to lose 90% or more of their value over the next 10 years. However, they are just as likely to be the best performers out of this bucket, depending on how things turn out. The third group is going to be what I call the huggers, and those are the companies that are going to closely match whatever the index does over the next 10 years. And the fourth group might not have the individual highest performers, but the safest are the ones that I think have the highest likelihood of beating the S&P 500 over the next 10 years. So let's dive in, starting with the riskiest stocks. Coming in at number 25 is Super Micro. Look, this is a company that, in my opinion, doesn't really have a defensible moat. It also, by the way, has some accounting issues that it's had to deal with over the last couple of years. The optionality, in my opinion, is not really there looking forward. I will point out that trading at just 11 times forward earnings, it does look somewhat attractive. I'm not willing to give it a green because it is experiencing some pricing power now, not because of any moat that it has, but just because of a supply constraint, which is allowing them to get better gross margins than they normally would. So number 25 is Super Micro. Coming in at number 24 is Dell. Look, this is a very well-established company, but it functions in a largely commoditized industry. Like Super Micro, its moat isn't really there. The reason that it's doing well has more to do with the fact that it is offering what I call water in a desert. It is helping build the AI infrastructure stack when the supply for that is in short demand. But that won't always be the case over the next 10 years. And pay attention to that because it is a theme that we will revisit over and over again. Now, I will admit that Dell does have some more optionality than Super Micro does. And let's look at the valuation. I think that on a regular run rate, once supply and demand are equal, if we give this company an 8% free cash flow margin, that would mean that using a reverse DCF, it needs to grow its revenue by about 12% per year. Look, they're expected to grow 50% in the next year because of those supply constraints, but how long will that keep up? That is anybody's guess, so I give it a yellow. Coming in at number 23, we're talking about memory chips. SanDisk is one of the names that's just gone parabolic over the last couple of years. But I will argue that this is a company that, again, doesn't really have a moat. It's a largely commoditized industry. Now, I will say that there aren't a ton of players that offer memory chips, and so maybe there is some pushback there. But I don't really see a ton of optionality from SanDisk, and I don't give it a great valuation. You might be looking at this and saying, wait a minute, it's right now, it looks quite attractive based on a forward earnings perspective, and that's fair. However, right now, in the most recent quarter, SanDisk had 50% free cash flow margins. There's no way that that's sustainable. I ratcheted it all the way down to 10% based on where it is historically. And if we do that, then the company needs to grow their revenue by 43% per year over the next 10 years. Look, I have no doubt that the next couple of years might be very good for SanDisk, and it might be very good for SanDisk shareholders, but this video is focused on the next 10 years, and so that is the valuation ranking. And then this is the one that I think might get the most pushback about, which is Micron. A lot of the things that I said about SanDisk are true with Micron, where the moat I don't really see there in comparison to the other memory chip makers. There is some optionality. They can come up with new designs that help the AI infrastructure stack function even better moving forward. And I will say that the valuation here looks better. Here's what I mean. Right now, Micron doesn't have those 50% plus free cash flow margins. In the first quarter of 2026, it was at 23%. I think a steady state that the company could hit is roughly 17% free cash flow margin. So it's not that much of a delta. If they do that, they need to grow revenue by 33% per year over the next 10 years. Now, that might seem like a high bar, but the company is expected to grow revenue 72% in the next fiscal year. So I do see a little bit of validity in owning Micron over the next couple of years. But again, I'm focused on the next 10 years. And I just think that when there's a supply glut like this, and when companies are able to charge as much as Micron and SanDisk are, then all the other players in the industry are incentivized to come up with their own in-house solutions. And I'm not sure the company's moat is going to be enough to hold everyone at bay. Now, if you like this type of analysis, I want to let you know about my program, Stock Investing Mentor. It comes in 3 big parts. Number 1, you get real live access to my real life portfolio, over 90% of my personal net worth. 2, you get ongoing coverage of stocks in my antifragile stock universe, and every month a top 5 stocks that I would buy if I was starting my own portfolio today. And number 3, 1 hour of live weekly training that is recorded, as well as 24/7 access to a private online investing community. And if you use the top link in the show notes below, you will also get 100% free access to Stock Simplifier 2.0, which is over a $300 value. And you can think of Stock Simplifier 2.0 as kind of like a junior analyst that does research for you. Now, I pulled up what Stock Simplifier says about Micron right here. It disagrees with me. It thinks, for instance, that the company actually has a narrow but widening moat, and that I would have given it the wrong designation. And it tells you why, with switching costs, how strong the IP is, and also low cost production. And not only that, but it gives you a full breakdown of why it says that. So if you're interested in Stock Investing Mentor with Stock Simplifier absolutely free, again, top link in the show notes below will bring you there. All right. Let's get on to group number 2, which is probably the most interesting of these, because these are the stocks that will be the biggest losers and also probably the biggest winners. Coming in at number 21 is UiPath, a SaaS name that helps automate a lot of things that we need done, which AI has really kind of taken the lead in doing in and of itself. And because of that, I say the moat is yellow. Now, the reason I think it's a narrow moat is that once large legacy organizations start using UiPath, it is painful to rip out. But you have to wonder how much motivation is there for newer customers to use UiPath as opposed to, say, Anthropic. Now, there is optionality built into what the company does, and we shouldn't ignore that. And the valuation is actually not that bad. I gave the company DCF. If we give them a 30% optimized free cash flow margin, then it really only needs to grow about 1% per year moving forward. So one of 2 things is going to happen. There's no way it'll hit those 30% free cash flow margins, or the growth just needs to do very, very modest growth. Right now, it's expected to grow high single digits over the next couple of years. And the only reason I didn't give it a full green there is because it's hard to say the direction that this revenue growth is really going to go in. But this could be a big winner. It could be a huge loser. It's hard to say. Coming in at number 20 is Intel. Look, when it comes to Intel, the moat that the company really has is that it's the only US-based chip manufacturer, and being able to manufacture chips is gold today. It is everything. And the US government is getting behind it and doing everything it can to make sure it is relevant, because we need chip manufacturers in the United States. That's where the moat comes from. It's also where the optionality comes from, because you can see that the government might be incentivized to push as much business towards Intel as possible. Now, when it comes to the valuation, here's what we have to say. It's really hard to know what kind of free cash flow margins this company could have once it's done, because we don't know how much its capacity is going to grow over the next couple of years. But if we give it a 17% optimized free cash flow margin, it still needs to grow its revenue by roughly 27% per year for 10 years to justify this stock price. And right now, it's only expected to grow about 10% over the next couple of years. So the valuation gets a red there. Coming in at number 19 is a name that you might not have heard of as much if you're not paying attention, and it's Applied Optoelectronics. This is a newer name in the optics, which is what helps all these servers that help bring AI to you communicate with one another. It's a much faster, more reliable way of connecting servers than copper, and it is gaining a lot of popularity. Now, I don't think that there is a defensible moat right now. I think in a lot of ways, Applied Optoelectronics, in growing its capacity, is benefiting from the same thing that helps SanDisk and Micron. And it might be a phenomenal stock to own over the next couple of years. But again, we're looking out over the next 10 years. Now, I do believe that there is some optionality built into what this company is doing. And when we talk about valuation, I gave it a red, but here's the caveats that I think need to go hand in hand with this. Applied Optoelectronics, I gave them a 10% optimized free cash flow margin. If they do that, then it needs to grow 43% per year for the next 10 years. That is a crazy high number. At the same time, it is expected to grow 130% per year over the next 2 years. So the trajectory of this could change very quickly, which is why this is in basket number 2 and not basket number 1. All right, coming in at number 18 is Duolingo, the popular language learning app. This company was flying high, and then it got hit by a double whammy of both concerns about AI, putting it into obsolescence, and second, some waning popularity in terms of its freemium model. That moat has really come under question. The streak and the switching costs are really the big thing, and the brand, we're waiting to see whether or not that's there. The optionality is there, but it's not yet proven. Language learning is the bulk of it. We've seen some traction come from chess, and math and reading are there as well, but we have to wait to see whether or not that becomes needle moving. I will say that on the valuation, Duolingo looks very attractive. Even if we assume that it just has 25% free cash flow margins, the company only needs to grow in the single digits to justify today's stock price, and it is expected to grow faster than that moving forward. Whether or not improvements to the platform really re-accelerate that revenue growth is the big question that will determine whether this is a big winner or a big loser. Coming in at number 17 is Adobe. Look, as soon as Nano Banana and all of these other AI programs that have visual renderings came about, Adobe was under attack. In fact, this slideshow itself is coming to you through a combination of my work on Google and on Anthropic. Didn't use Adobe at all. So you can see why that moat has come under question. The problem is that the company is putting forth a lot of AI tools like Firefly in their tool belt, but we don't know how the trade-off between seats and usage, between the AI tools, can they make up for the canceled seats? We're not sure how that's going to shake out. I will say, however, that the valuation is compelling. If we assume that Adobe has 35% optimized free cash flow margins, which is lower than what they've been traditionally, they still are expected to shrink overall based on the stock price. Now, expectations are for high single-digit growth, which means, again, that if they can prove that AI can re-accelerate revenue growth or even hold it steady at about 10%, this could be a huge winner. Now, those themes are going to play out throughout many of these names, including number 16, which is Salesforce. Again, I think Salesforce's moat is definitely there with existing customers. It would be painful to rip out and put in a new system, especially if you're trying to build it in-house. However, for newer customers, there are going to be alternatives, including building in-house. And so that AI optionality is a big question. I'm not going to give it a green because Agentforce is great, but we don't really have clear enough vision as to whether or not Agentforce is being built on top of a business that's not losing seats, or if Agentforce is kind of being canceled out by the loss of seat-based revenue, which is this company's bread and butter. I will say that if you do invest in the company, you are getting a very good valuation at today's rates. If you give them 30% optimized free cash flow margins like Adobe, the stock price assumes that it's actually going to shrink going forward. Now, analysts expect, as well as with Adobe, high single-digit growth, and if they can do that, reaccelerate their revenue growth, show that they're not losing seats, or that agent force is such a force that it can reaccelerate that revenue growth with attractive margins, because that's important. They don't have the gross margins with AI tools that they do on their legacy SaaS. Then this could be a huge, huge winner. Now, coming in at number 15 is a company that's really the leader in the same industry that Applied Optoelectronics was in. The difference is that this company definitely at least has a narrow moat because it is a fully vertically integrated laser and optics company. They manufacture their own crystals and everything up the supply chain. The big thing here when it comes to optionality is if their co-packaged optics are able to become an industry standard, that would become huge optionality, and it would probably cause a re-rating on the stock because of the potential that it could open up within AI data centers moving forward. But that is not a sure thing. We don't know if that will happen. And right now, the stock kind of assumes that it will. Here's why. If we give the company 15% optimized free cash flow margins, then today's price assumes that revenue will grow 25% per year for the next 10 years. Now, they are expected to grow by at least 35% over the next couple of years, so that's above that bar, but keeping it up over 10 years, especially in a cyclical industry, that is a question that investors need to answer for themselves when they decide if this is going to be a huge winner or a huge loser. Coming in at number 14 is Tesla. Look, when I think about Tesla, really almost all of these are hard to do. Does it have a moat? Well, it did in EVs, but EV demand has gone down so much, it's hard to say. In storage, it's hard to say. But the big question really just has to do with its optionality, robotics, full self-driving, and electrification. We don't know how those things are going to go. We do know that it's facing stiff competition from the likes of Waymo in some of those categories. And we're really in a wait and see category. I think that no matter how you cut it, it's impossible to know what type of free cash flow margins to give this company. But I will say, even if you give it 15% free cash flow margins, then it still needs to grow its revenue much faster than it's expected to, so I give it a red for valuation. Coming in at number 13 is Datadog, a software as a service observability platform that really has become more and more important in the age of AI and AI agents. Now, I will say on the moat, I waffle between narrow and wide. I would say it is a narrow moat that is widening because this is a tool that's really important to be able to see how all of your digital functions are working. And it is much harder to replace with AI. Instead, it becomes a way of looking at what's happening in the age of AI. I think that there is a lot of optionality baked into this, not only because of AI, but because of the history of optionality that Datadog has shown since it went public. Now, the valuation right now, I would say, is fair. Look, their net revenue retention clipped up from 115 to 120%, which means that that optionality is there. If we give it a 30% optimized free cash flow margin, the stock price today assumes that it will grow its revenue 26% per year for a decade. That is a high bar, and it's only expected to be in the mid-20s moving forward. But there are two things to remember. The first is that analysts have underestimated for a while on Datadog, and the second is that this is not cyclical the same way that the fiber optics and the memory chip players are. So that is worth keeping in mind. Coming in at number 12 is ServiceNow. Much like Datadog, this is a tool that, in theory, should help with the observability and orchestration of AI agents. Now, the moat and the optionality are really come into question here because ServiceNow recently said that their AI tool has gone from a $1 billion revenue run rate to $1.5 billion by the end of 2026, which is great. The problem is that is still a tiny slice of the company's revenue. And if you do some reverse engineering, the growth of the core stable business, the legacy business, has slowed considerably to the low teens, maybe just very low double digits, which is a huge slowdown from where it used to be. So there is some reason to doubt what's happening here. At the same time, it's worth pointing out that you're getting a pretty compelling valuation. If you give the company 35% optimized free cash flow margin, then it only needs to grow its revenue by about 9% per year over the next 10 years. Given that growth is expected to be in the high teens over the next couple of years, with the potential for some reacceleration, that does give hope for shareholders today that it will be on the big multi-bagger side instead of the huge loser side. Coming in at number 11 is cybersecurity firm CrowdStrike. Look, cybersecurity has become more and more important over time, and we have seen in CrowdStrike's ability to not only survive, but thrive after the massive outage that it had in July a couple of years ago, that the moat around this company is strong and the number of tools that it's offering just keeps growing. And that is why the optionality is really very clearly there as well. At the same time, the valuation is incredibly steep on this stock at this point. If we give them 38% optimized free cash flow margins, which is the high end of what management says that they can do, then they need to grow their revenue by almost 30% per year for 10 years. Now, I'm a shareholder myself, but even that is very, very optimistic, especially considering that analysts just expect low 20% growth over the next couple of years. And coming in at number 10 is Palantir. Look, this company is all over the news. Very few people really understand what it does. But I will say that once a company signs on and starts using Palantir's tools to help improve the efficiencies and the ability to benefit from all the data that they collect, they're not leaving. They've also shown incredible optionality in going from government enterprises. Their forward software engineer program to accelerate their growth has shown incredible success. And the only real sticking point here is the valuation. Now, if we give the company 35% optimized free cash flow margins, and I'm being very, very conservative, I'm assuming that there is going to be some pressure that comes from Anthropic and the likes in the years ahead, because remember, we're trying to think 10 years out here, then the company needs to grow the revenue by 35% per year over the next 10 years. Now, if you give them higher free cash flow margins, then that's lower revenue growth that's needed. That said, it's expected to be 50% plus over the next 3 years. So that is achievable, and it's why it comes in at number 10. All right. This next group we're going to give are the huggers. These are the companies that I think over the next 10 years will largely be close to what the S&P 500 returns over the same time frame. It might be 2 or 3 percentage points above it per year, 2 or 3 percentage points below it, but it's not going to be the huge variance like we talked about with the previous group. Coming in at number 9 is NextEra Energy. Now, NextEra Energy recently announced a huge acquisition of Dominion Energy in Virginia. Everybody knows that energy is the huge bottleneck that's coming up along with chips and fiber optics. The moat around this company is very wide, not only because of some of its regulated businesses, but also its renewable energy business. There is some optionality, but not the same type of optionality that we see in other avenues. It's really just expanding its capacity that it really comes to. And I would say that the valuation is fair. It's trading at about 21 times adjusted earnings right now. Coming in at number 8 is GE Vernova. This is the company that was spun out of GE. Its core business is manufacturing natural gas turbines, but it does have its hands in electrification, switches, and also it has an ancillary play in even small modular reactors, which really hasn't been needle moving at all, but it's worth noting. The moat here is real but narrow in that they have the manufacturing capacity to be able to, once supply and demand do even out, offer these things at a lower internal cost than some of the rivals, and they are expanding that capacity, and they do have optionality in the areas that I already just talked about. Now, wind is a drag on the company, but those turbines, the electrification, and the exposure to small modular reactors give it some nice optionality. I would say that the valuation today is fair. If we give them 17% optimized free cash flow margins, which is probably a little bit lower than where it is today because the company does collect deposits, and once supply and demand even out, that's not going to be a huge driver for free cash flow, then it needs to grow about 16% per year over the next 10 years. And that's roughly what's expected over the next couple of years. With the backlog growing, I think that's a fair valuation. Coming in at number 7 is Taiwan Semiconductor. Now look, there's no doubt that this company has an enormous moat around it. It's probably probably the most irreplaceable company in the world at this point. However, the optionality is limited. Now, don't get me wrong. Taiwan Semi is going to be manufacturing new chips. Its chips on a wafer on a substrate is a huge business, and there are going to be new iterations of these chips in the age of AI. At the same time, we just need to point out that Taiwan Semi has historically operated in a very cyclical industry. It knows that, and while it is expanding capacity, it's going to be careful about overexpanding, because if it does and it gets caught in a cyclical downturn, that can be a real problem. I believe the valuation today is fair. If we give them optimized 30% free cash flow margins, that means that revenue needs to grow at about 20% per year over the next 10 years. To put that in perspective, it's expected to grow about 25% over the next couple of years. But again, remember cyclicality. If and when a downturn hits over the next decade, that's where everything comes into question. And the last tugger of them all is ASML. Now, this is the company that makes many of the machines that are used inside, say, Taiwan Semiconductor or Samsung or Intel to help make the chips. The moat around this is almost unassailable. So there's no question there. And there's definitely optionality, because as new chips come out and as new lithography technologies come to play, ASML is going to be at the head of the pack on that. The big thing here is just the valuation. It has come down a little, but if we give ASML a 35% optimized free cash flow margin, it needs to grow at about 22% per year over the next 10 years. Here's why that's a problem. Right now, we're in the middle of the S-curve of the adoption of AI, and even then, ASML's revenue is only expected to grow 20%. Moving forward. That's below where it needs to be over the next decade, and so that's why it is in the huggers category instead of the final category. The reason I call them the safest is not because I necessarily believe that these will be the best performers out of this group of 25, but I believe that they will be the best bet to beat the market over the next 10 years. And before we get to this list of the safest, it is worth pointing out the stocks that did not make the list, not because they don't deserve to be there, but because I did an earlier video and many of these landed in this group as well. That includes a lot of the Mag 7 stocks like Google, aka Alphabet, Amazon, Microsoft, Meta platforms or Facebook, and Nvidia. So know that all of those companies belong here as well. Now, that being said, let's go through the top 5 from what this list was. Coming in at number 5 is Constellation Energy. Now, this one might be a little bit surprising. This is the United States' largest nuclear energy player, but it is worth noting that they made an acquisition of Calpine recently, which diversified. The bottom line is that this is an energy company that has a very, very, very wide moat. And it is worth noting that because it is in such an important and regulated industry, it has kind of a higher floor to it than we saw with NextEra Energy. There is some optionality in there. They did acquire some of that optionality. But I would argue that the valuation, especially given the fact there is I would say a higher floor for this company and its performance, is what gives it that. And right now, I'm just checking my notes. Right now, Constellation Energy, because of those more solid contracts, it's trading for about 22 times adjusted earnings, which is just about what NextEra Energy is. But again, nuclear power, this is more locked in. So that is why Constellation Energy came in at number 5. You could say that this one would be in the hugging the index category as well, but I decided to nudge it there. These next 4 will be interesting to see what people think. Number 4 is Cloudflare, content delivery network, or at least a company that started as a content delivery network and then became much, much more than that. It is kind of the gatekeeper for the internet, and by and large, it is showing itself to be a gatekeeper for agents on the internet as well. The moat here to me is very wide, because not only does the company, once it lands its customers and expands within its customers, it also owns and operates different servers throughout the world, which are all within a small number of milliseconds from end devices. And that moat, I think, gets stronger and stronger by the day. It has clearly demonstrated optionality, starting out as content delivery network, becoming a cybersecurity firm, and again, as I said, really focusing on AI agents and being a gatekeeper and a toll booth on the internet in that realm. I would say that the valuation is a yellow. Some people will rightfully disagree. Here's the deal. If we give the company 25, 26% free cash flow margin once fully optimized, then it needs to grow by 30% per year for the next 10 years. Full stop. That sounds ridiculous. That being said, it is expected to grow at about 29% per year over the next 3 years, and that growth has been reaccelerating and has often come in ahead of analysts' expectations. The bottom line here is that I think that this can be an above average grower for more than just the 10 years that a reverse discounted cash flow analysis allows. And I believe that that will become more and more obvious as we work ourselves closer to 2036. So I'm really taking the long view here. There's pushback on this one. I completely understand it. Coming in at number 3 is Broadcom. And the reason for this is that it's a combination of 3 different businesses. It's got that reliable, high margin software coming in through its acquisition of VMware. It's got its networking equipment. And the big boom recently has been helping design custom chips for hyperscalers like Amazon and Google. So I think that the moat is quite wide there. And I think that they have demonstrated optionality in their ability to become the design partner for many of these hyperscalers. And I don't think that the valuation is ridiculous. It's high, but it's not ridiculous. If we give the company a 40% free cash flow margin, which maybe you might push back and say that's a little bit too high, but you got to remember there is that high margin VMware software as a solution revenue coming in, then the company needs a 22% revenue growth rate for the next 10 years. Of course, that is a very, very high bar. It is expected to be above 50% over the next year, and this is cyclical, so a little bit more kind of valuation problems there, but the bottom line is that the moat and the optionality are definitely there. Coming in at number 2 should be no surprise because it's one that I talk about all the time, and that's Axon Enterprise. This is a company that started out by focusing on stun guns, moved into body cameras, then into software as a solution with Evidence.com and Axon 911 dispatch. It's got a drone segment. It's got a D-drone or an anti-drone segment. And importantly, it just released its AI era bundle, which does things like fill out the first draft of a police report, offer real-time translation services, and it is a very, very meaningful booster to the company's top and bottom lines and has been adopted quicker than almost any other software solution that they offer. Very few companies this side of Amazon have shown optionality that comes anywhere close to what Axon has demonstrated over the last 15 years. And I actually believe that if you look at the multiples, you're looking at the wrong thing when it comes to valuation with Axon. That's because they are pouring all the revenue they get right back into the business, and that makes those multiples look artificially high. The bottom line is they had 20% plus free cash flow margins when they just sold Taser stun guns. You throw in all the software services on top of that, I believe it could be as high as 30%. And it is. Then today's price assumes that the company is going to grow their revenue by about 19% per year. Now, that might sound like a lot over 10 years, but they are expected to grow by at least 30% over the next 3 years, and they have been growing at that pace over the last 5+ years. So I actually think that this is a company that should really outperform the S&P 500 over the next 10 years. But what is my number 1 stock? It is actually Shopify, a company that helps just about anyone set up their own online e-commerce presence. This company has set itself up as the anti-Amazon. It is a way for merchants to own their digital property and not be beholden to Amazon and giving all of their information to Amazon. The switching costs here are clearly enormous because the company has shown an ability to raise prices on their subscription plans without missing a beat on everything else. And I will say that the optionality is really clearly there. I was listening to a Stratechery podcast recently where they were talking about the future of e-commerce in the age of agentic AI, and they said that brand.com, and what I mean by brand.com is company's name .com is getting 4 to 8 times more traffic than the traditional marketplaces like Walmart or Amazon, and the number 1 player there is Shopify. I think that this company is really set up for long-term success, and I actually think that the shares are actually quite attractive right now as I look at them. If we give the company a 24% optimized free cash flow margin, that assumes 19% growth per year, just like Axon, over the next 10 years. The company is expected to grow by about 25%, but it's important to point out two things. One, revenue growth has re-accelerated, and I think that we're underestimating the growth in gross merchandise volume that Shopify is going to show in the age of agentic AI, and their take rate of that growing GMV is growing as well. So that is my number one safest bet in the age of agentic AI. Let me know what you think in the comments section below. Till next time, Brian